Now we're going to continue on with the following example that's illustrated in the textbook on page 84. And basically what we're doing is we are making journal entries into the journal, and we're taking that information and transferring it into your ledger. And so transaction 12 says to purchase a building with a notes payable. So let me address to you guys what's the difference between a notes payable and an account payable. Remember, we said that most of our liabilities, those accounts that we owe, those things that we owe, their last name is always going to be a payable. Okay, and so naturally speaking, from here moving forward, you will always see either notes payable, accounts payable, salary payable, wages payable, all those sorts of payables. Now, what's the difference between a notes payable and an accounts payable? A notes payable is more of a formal black tie version of an accounts payable. Notes payables are always written, and more than likely they will involve some type of interest payments. Okay, so notes payables always have interest. They're formal. They're always written, and a lot of times they last longer than a year. Okay, so let's suppose that we purchase a building by signing a notes payable. So what are the key words? We purchase a building, signing a notes payable. Well, obviously, building is the key word, notes payable is the key word. Okay, so we address the key words. What accounts are affected? The building is affected, and the notes payable. Now, what is happening with the building? Is the building going up? Yes, it is. The building is increasing in the business, and the building is an asset. And by the way, let's put our all clear system up here so you guys can remember that. Well, hopefully you have that already on in your notes and stuff. So apply the all clear system to whatever we're doing right now, and you should be fine. But again, building is an asset. The building itself is increasing. And so what are we going to do to the building in terms of journalizing? We're going to debit the building. So we're going to debit building. And the price was $60,000. So we're going to debit building for $60,000. And we're going to credit something, right? What's the other key word? Notes payable. Last name payable, so we know that that's a liability. And how do you increase liabilities? Through a credit. So we're going to credit notes payable. We know that we have to credit this notes payable because we have more liabilities now than we did before this actual purchase. Our liabilities have increased. Okay? Next transaction. Suppose that we issue stock for furniture of $18,000. Suppose that we issue stock for furniture of $18,000. Now, normally when you issue stock, you receive cash. That's the main purpose of issuing stock, to raise cash. But in this particular example, instead of issuing stock for cash, we did it for furniture. Okay? So think of it as a fair trade. So how are we going to record this? What are the two key words? Issued stock, obviously, and furniture. Okay? Let's identify furniture. What is happening from the business perspective? Furniture is doing what? It's going up, right? And furniture happens to be an asset. Okay? So how do we increase assets? Obviously, by now you should understand we increase assets by debit. So what we're going to do is we're going to debit furniture because furniture is going up for $18,000. And then next we need to identify the other key word, which is issuing stock, issuing common stock. Now, common stock should ring a bell because we know common stock is a part of stockholders' equity. What part of stockholders' equity is affected through common stock? Paid in capital. And so whenever we issue stock, we have more stock. So the stock is now increasing. So how do we increase any part of stockholders' equity? We do it through a credit. So we're going to credit common stock for $18,000. The next transaction deals with providing a service for $8,000 cash. Suppose that we provide a service for $8,000 cash. Okay? What are the key words? Providing a service and cash, $8,000 cash. So we provided a service, we received $8,000 cash. Let's identify providing a service. When you provide a service, why is that a key word? Because that's a definition for a particular account. Anytime you provide a service or sell a product, we go straight to what account? Revenue. Revenue affects what part of the accounting equation? Stockholders' equity. How? Through retained earnings. Retained earnings, one word definition is income. And how do we measure income? Revenues minus expenses. So anytime you have expenses, that affects retained earnings negatively. Anytime you have revenues, that affects retained earnings positively. So we're increasing stockholders' equity through revenue. Now, how are we going to record revenue? Are we going to debit revenue or credit it? Look at your all clear system. Revenues are in the clear group, and anytime you have to increase the clear group, you do what? Credit it. So we're going to credit service revenue. I know I'm kind of working backwards. And let's say it was for, I don't know, $2,000. And of course, we're not finished because we have to debit something. What was the other key word? Cash. We received cash. Okay? So how are we going to handle that? Cash is coming into the business. Cash is an asset, and you always increase assets through a debit. We're going to debit cash. Now, I want to just kind of keep you guys, and I'm going to always do this throughout this lecture, but kind of keep you guys kind of like to make sure that you are all focused and connected to the big picture. The big picture is knowing that all this stuff that I'm talking about in these videos, they're connected. That's the big picture. And the big picture is in order for you to really understand accounting, you have to have a certain type of habit in terms of fundamentally understanding what's going on. And that habit has to come through practice. These are concepts. And so with concepts, you have to apply them to really understand them. That's the only way it works. Anything with a concept, you have to apply it, right? Theories, you just understand theories. You test them, and once they prove our theories, you really just understand them. Let's not get too sophisticated with it. You just understand them, right? But concepts, you have to know them through application. You have to know how to apply them. And so you have to work the problems, guys. Plenty problems, okay? So, we've already journalized these 3 transactions. Now it is time to take that information and transfer that information to our other other book, called the ledger, okay? And so, let's do that. So obviously we see that we have in building and furniture. These are new accounts that we don't have on the books yet. So let's create those. So I'm going to lower this a little bit because we don't need all that space right there. And I'm going to go ahead and stick a building right here under here. And I'm going to go ahead and stick a furniture right under here. And the building was for $60,000, so we're going to debit that. Don't forget to also credit your notes payable, which we do not have. So we need to stick a notes payable in here. I'm going to just go ahead and put the notes payable down here. And we're going to credit this notes payable for $60,000 as well. And we're going to move on to the second one. The furniture is $18,000, so we're going to go ahead and plug that in there on the debit side. Our common stock, we need to find common stock, and it's up here. And we're going to add another $18,000 on the credit side. Okay. We move on to our last transaction, which deals with cash. So we find cash at the very bottom, and we're going to debit another $2,000 in cash. Then we're going to move on to our service revenue. And see our service revenue, so we're going to go and apply that for another $2,000 on the credit side. Okay? And basically this is an example, an extensive example of your journalization process and your posting of the information from the journal to the ledger. Critically important that you understand exactly what's happening with these videos.